Ron the Mortgage Guy is back. Interest rates are up. The real estate market is down. Is it too late to get a mortgage to buy a house? The answer to that question and a lot more starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ron Butler is the proprietor of Butler Mortgage. So I'm going to ask him where he got the name from. He is back making his fourth appearance on the Debt Free in 30 podcast. He was my guest back on episode number 293 in April of 2020, right at the start of the pandemic, and then 334 in January 2021, where we discussed the risks that Ron saw in the market. He was right about pretty much everything. Episode 376, November of 2021, we discussed whether or not you should help your child get a mortgage. Pretty sure my answer was no. I'll put links to those shows in the show notes on YouTube. You can go to your podcasting app, search for Ron Butler and Debt Free in 30, and they'll all come up. So, Ron, welcome back.
Good to be here, Doug.
So, I ask you to be on this podcast, obviously for the fourth time, because you're not just some TV pundit who makes stuff up. You're actually on the ground working with clients every day, and obviously all of your people there are doing the same. So, let's start just very basically with what Butler Mortgage does. Obviously, you're in the mortgage business, but are you doing mostly commercial, mostly residential? What geographic area? Tell me what specifically you guys are focused on.
Butler Mortgage is licensed in 3 provinces. Almost all the business comes from Ontario. Growing chunk of business coming from Alberta, some from British Columbia. Those are the 3 provinces we're licensed in. And we're like 98% residential. That's what we do.
Perfect.
All kinds of it, like bank mortgages, alternative lender mortgages for people who have some issues, and private mortgages for people who have a ton of issues, and really the full gamut of residential mortgages.
So if I have fantastic credit, I can come to you and you'll shop it and get me the best rate. If I have lousy credit, well, you've got your own private sources who are more interested in the equity in the property or my income as opposed to my credit, that sort of thing. Is that essentially?
Yeah. So if you're just a perfect candidate, which many people are, that's the lowest possible rate. Like literally us discounting the rate through a severe reduction of our own commissions to give you the lowest possible rate in the marketplace. For those who have some either credit impairments or some real difficulty in proving their own income, they use various systems to reduce the taxable income that they provide every year. We have alternative lenders for that. We have people like Home Trust, Equitable Bank, institutions. So that's still a great advantage to people. And finally, the private mortgage for people who have really specific problems and can't get any interest from any institutional lender. So we run the full gamut.
So if I'm some really rich guy and I got $100 million in my jeans, I could phone you up and say, "Hey, Ron, I'm happy to loan some of this out as private mortgages." So I do not have $100 million in my jeans. So I likely will not be making that phone call to you.
We do talk to investors in private mortgages, but the truth is we're very selective. Our company funded a $1.574 billion worth of mortgages last year. So some of that's my son's division, and I work with, obviously we have a crew of people here, but only about $22 million, $30 million of that was private lending. So that's a small part of our business. We don't actively solicit investors for private mortgages, unlike some of my peer group, because the truth is we're ultra conservative about it. We're endlessly worried about it. And we don't come anywhere near the kind of rates of return that, again, some of our peers try to tell people they should be getting.
Because you're conservative. That would make perfect sense to me.
Probably to my detriment, to be honest with you. Probably to my detriment.
Well, you're still alive and kicking. So I think that's probably, a good commercial for the fact that it's working. So, okay. So anybody who's watching this, don't be pitching Ron with your private investment ideas. He'll just tell you to put it all in crypto, and that'll be the end of the discussion. So, okay.
It will be the end in more ways than one. Yes.
That's right. So back on episode number 399, I think this is episode 403 we're on now. My guest was Nasma Ali, a real estate broker in Toronto, and we recorded that episode about a month ago, April 20th. And she told me that she first started seeing the real estate market soften around February 15th, which surprised me because the interest rate increases didn't happen until, March or April. So did you see the same thing? Was it sort of mid-February that things started to get softer?
Yeah, I call it the third week of February.
There you go.
The top third week of February. Rates were going up. I mean, they weren't going up as rapidly as they are today. We didn't, the prime rate change hadn't occurred yet, but fixed rates were absolutely starting their upward movement in February, and it just cast a chill over the whole marketplace.
So let's talk about the whole marketplace here then. So on that show, I pulled some numbers. I don't know if they're still valid or not, but according to the internet, that's where I get all my information, Ron, the internet, because it's always 100% accurate
right.
and true, always true. The average sale price of a house in Toronto, March 2020, about $900,000. March 2021, about $1.1 million. March 2022, about $1.3 million. So let's say I want to buy the average house. I got a 20% down payment. I get a 5-year fixed rate mortgage, 25-year amortization. So back a month ago, I went to your website, butlermortgage.ca, I believe is what the butlermortgage.ca. You have a mortgage calculator on there.
Yep.
So I punched in the numbers. And so if I had bought the average house with a 20% down payment, the monthly payment in 2020 would have been about $3,200. In 2021 would have been about almost $4,000. In 2022, March of 2022 would have been about $5,100. And that's because the price of the house went up and the interest rate went up. So when I did this analysis a month ago, the 5-year fixed rate, 25-year AM was about 3.38%. I don't know what it is today, but I assume it's somewhere.
It's in the fours.
It's in the fours now. Okay, so I should have done more show prep and the number would have been even higher. The point being that in a couple of years, the mortgage payment on a typical home is up by $1,800 a month, I guess even more now. So how are you supposed to be able to buy a house? And when you look at the income required, I mean, it went from like 90,000 to it's probably like 150,000 or something today to qualify for that average typical Toronto house. So, and when I posted this on Twitter, your favorite medium, because everyone is intelligent there, I had lots of questions about, hey, is this gross or net or what? And you chimed in with your responses and all that. So my question for you then, how is someone in this market supposed to be able to buy a house? And we're going to talk about what the market looks like next, but overall, what is someone supposed to do? How are you supposed to be able to afford a house?
Well, within the framework of what we talked about on the last podcast, you add an extra applicants. You add more people to your application. Talk to a executive at a big Canadian bank in March, and she said, our incidence of more than 2 applicants has gone up about 50%, and particularly in Ontario.
Wow.
Most of the stuff I'm relating is about Ontario.
Yeah.
We got to realize that the real estate and mortgage world in Brandon, Manitoba is radically different than most of Ontario. So it's just a whole different world. But in Ontario, she said, yeah, it's up 50%. Huge, theoretically a huge increase. I mean, that's a big number. So those are the things, bigger down payment, through parental gift and extra applicants. That's how people have been managing this problem of super high prices for the last 6, 8, 10 months.
Yeah, and that's exactly what NASPA said. It's 2 things. You're getting money from mom and dad, or you're getting, or you sold your house and you're buying a new one, because then you've got the equity from that. But yeah, it's some external resources. Okay, yes. So you said third week of February, that was kind of the top in the real estate market. Maybe not the top for all time, but the top at this point in time. So we are recording this, I believe it is May 16th, 2022. The Leafs are already out of the playoffs, so we know it must be the month of May. So of course it's a given. So what is going on right now? What are you seeing right now? Tell me some stories from on the ground.
I'll give you a couple of interesting stats. So we compare this April to last April. And let's use big numbers, like big provincial-wide numbers. All 3 mortgage insurers, that being CMHC, Sagen, and Canada Guarantee are indicating that their applications, April versus April, are down 40%. So now we move over to Equifax and TransUnion, where you with just credit bureau polls from mortgage operations, also down 40% month on month, year on year. So that to me, sure, April 2021 will go in the record books as one of the best months. The whole year 2021 was an extraordinary good year for the mortgage business, for the real estate business. If you're involved in those industries, all I can tell you is you made a lot of money. I hope the hell you kept some of it, because that's the object. That should be the object of the exercise. But big difference. I mean, 40% is a real number. So if there's 40% less credit pulls for mortgages, that's a pretty good indication of how different the activity level is. 2021 April, 2022 April.
Now, if I was to compare that, and I hear what you're saying, and obviously any time you do a comparison, this is what frustrates me with the media all the time. Oh, the bankruptcy rate was up 12% last month compared to the month before. Well, of course, it's a seasonal thing. It's always up in the spring compared to the winter, whatever. So you took April 2021 as your basis of comparison, which was a really booming peak month. If you had compared it to April 2020, well, of course, the economy was shut down.
It started by COVID, yes, that's right. Yeah.
And so if you compared it to April 2019, is it still down, do you think, from that
Absolutely.
period?
100%.
Still down. Okay.
Yes, 100%. It's down about 15%.
So we are at multi-year lows for whatever you call the mortgage originations or whatever.
Right.
And why is that?
Well, it's because the price of homes has come down. We call the top third week of February, and prices started to fall. Activity level, like the famous offer date, there are no offers. That's pretty much a running story in Ontario today. We've set an offer date. You better get your offers in. Hurry up. Oh, look at that. There's no offers at all. Okay, now let's think about open houses. Okay, we're going to have this open house this weekend. Oh, nobody actually came. There was absolutely no one showed any interest in that house whatsoever. It was a open ghost house. There was nobody there. So when you run into these type of situations, it's really amazing how quickly it goes into a narrative. Because let's face it, there's not really that many people looking to buy a house on any given month. I mean, we're, here, I'm a mortgage guy, I'm in the business. Nasa's a realtor, she's in the business, we're all in the business. So it's life and death for us. It's our daily work. Just like if you're in the grocery store, you're very attuned to the fact you couldn't get any tomatoes that day. You ran a grocery store, I can't get any tomatoes. This is a big, serious problem. But maybe if you're not buying tomatoes that day at that store, it's no problem at all. So we notice it in a very big way. But it's amazing, the people who are interested in buying a house or giving serious thought to buying a house, they somehow find this information out themselves very quickly. Very quickly they discover nobody's buying a house. There was no offers. Nobody went to an open house. Wait a second. Maybe I should just pause this house search. Maybe there's something's going on here. Maybe we should just wait. That's called market sentiment. So I'm telling you right now, market sentiment is pretty much just wait. And by the way, that is such you just talked about all those numbers for how much more it costs to own a home today, how much bigger the mortgage is, how much more expensive it is, how the rates have gone double. The rates have doubled. Now, they haven't quite doubled on variable rates yet, but give it till Labor Day, it'll be double. So prime rate will go up enough that it'll be double. Fixed rates are double, 5-year fixed rates are double. Alternative lender, let's call it the harder to get, mortgage needs credit issues, some blemishes. Those rates are a clean double as well. Like literally every rate by Labor Day in this country, every type of mortgage rate will be double. So that's the affordability issue coupled with the slowdown in activity in the real estate market. Well, there's no more fear of missing out. You don't have to be afraid of missing out on anything if nothing's happening. right? Like, what am I afraid of missing out on? There's lots of houses coming on stream. Nobody's even going to the open houses. The price of owning, the interest rate to own this place, to get a mortgage on this place is now double. Maybe I better just wait. Okay, and that's market sentiment. That's what we're experiencing right now.
And presumably that has a significant impact on prices too.
Yeah, the prices are falling. But it's important to understand that the prices are falling. I mean, Dan Foch made a real good point about this over the weekend. The last 10 or 12 months of the great real estate boom we've experienced, there was some investor participation, absolutely, but a lot of it was what we refer to as end users, people who are going to live in the house. They buy on emotion. They buy on FOMO. They buy on, fear of missing out, fear that the prices are going to go forever. And by the way, another kind of feeling that comes from FOMO, which is, I don't have to worry how expensive this house is. In 5 years, it's going to be double. Mm-hmm. So it's a great investment, no matter how I look at it. It goes up 15% a year, and that's great. That's fantastic. So I don't have to worry how much I'm spending. Well, that has vanished. That is gone. That is completely gone. So all those things combine to a great slowdown in the number of houses sold. I think the May numbers are going to be pretty poor. But going back to end users, these are people who can easily make a decision not to move forward. And these are people who made the most emotional decision when they bought in November, December, January. So those people really overpaid. That's the most intelligent thing to be said. And those people were buying homes not in old 416 Toronto, not in, Oakville, not in the old established high-end neighborhoods of central Toronto. They were buying on the outskirts, whether it's Barrie, Orangeville, North Ajax, Bowmanville, parts, the outskirts of Hamilton. They were buying in far locations because that's where there was the chance of affordability. And within their minds, the prices are just going to keep going up. So I just got to grab something that's affordable, not worry too much about the drive. And just because as long as I grab it, in 5 years, it'll be double, my life will be better, on and on. So those are the prices that are the most affected. I mean, you see I think some of the prices in North Durham are off 25% today versus that all-time high of February of this year. So that's a big number in a very, very fast progression.
Yeah,
not so much Central Toronto, Old 416, Oakville. Some of those properties are not off at all. Some of those properties are actually still going up. A sought after home in a great neighborhood. There may not be 20 offers, but there actually is an offer night. Like there are offers on offer night for some of those properties.
Well, if my boss is making me come back to the office, then I can't be living in Barrie. So the prices in the outskirts are going down and the prices in the center are perhaps retaining their value. So
sure, but the other big feature of that is the house prices in the center did not go up 50% in 2 years. They did not go up 65% in 24 months. They went up 20%. Because when you're talking 3 million, it's pretty hard to go to 4.5, 5, just in a very brief period of time. There's only a very restricted clientele for a $3, $4, $5 million house. So they didn't go up in price as quickly at all. Now, that's really a function of what happened on the outskirts and in small towns. The prices went up so fast, they have the most exposure to coming down quickly.
I totally get that. Okay, now explain to me timing. So I phone you up and say, hey, Ron, I want to buy a house. I'd like to get a mortgage. Now, the entire transaction is not going to be completed in 15 minutes because presumably I have to find a house and there's a closing date and there's this and that and the other thing. So if I called you up today and said, I want to lock in a mortgage rate so I know what I can afford, how long can I lock in a rate for?
90 to 120 days.
So it's very possible that 90 days is roughly 3 months. So I could have locked in my rate on February 1st, February, March, April, and then at the end of April, I'm going to buy my house, and it's like, oh crap. In fact, I could have even done the deal. When I buy the house, the closing date is a period of time after when I buy it, right? It could be a
30
few
days, 45 days, 60 days. Yeah.
Sure, a week, a month or two. So you've got a lot of people now who are buying a house, closing on it, knowing that they've overpaid by $100,000 or $200,000.
Absolutely.
And so are you seeing people walking away from deals?
They are. It's not a huge number because they are correctly cautioned by their lawyer and their real estate agent that you are going to get clobbered. Like you're going to lose your deposit, you're going to be sued, and you're going to lose. The case law in Ontario is effectively 100% in favor of the seller for people who want to abort real estate transactions during a time of falling values. There's hundreds and hundreds and hundreds of cases. The seller wins every time. So that buyer, no matter how much they wish to get out of that contract, are going to hear that it's going to be a devastating financial disaster if you try to get out. Because what happens if you try to get out? You will in all likelihood end up losing your deposit. You will pay the difference between whatever the seller can finally sell that house for. He relists and sells it. You may end up paying the difference. The seller may keep the home. He'll still chase you for that full value. I mean, it's just an absolute disaster for the buyer who thinks he can just turn a light switch and that's the end of the transaction.
What is the typical down payment deposit that I would be making when I'm putting in an offer on a house?
Today it's all between 25,000, 50,000, upwards of $100,000, depending on the value of the house.
So I could have put down $100,000 deposit. The price of the house might have dropped by $200,000.
Correct.
So I'm going to lose my $100,000 deposit, but then I'm going to be sued because now the seller can't sell it. He's going to sell it for $200,000 less. So they're going to come after me for at least another $100,000 plus all their carrying costs and legal fees and, mortgage and this, that, and the other thing. So you might,
and the case law is 100% against you.
So you might as well buy the house because you're buying it anyways. You're paying for it anyways.
Well, let's talk about the next issue then. What if the appraisal fails? Well, because if we think of the process of buying a house, you, just as you said, we're looking, find, negotiate, put in an offer accepted, 60 days go by. During that 60-day process, in many cases, an appraisal is being done. What if the appraiser says, you know what, I think you overpaid $50,000 for this house. So that's $50,000 off of the purchase price that the bank is willing to lend you. They'll lend you 80%, not of the purchase price. They'll lend you 80% of the appraised value. Suddenly you've got to come up with another $40,000. Maybe you have it, maybe you don't. Maybe it's $100,000 less house. Now the appraisal comes in $100,000 less. You got to come up with even more money. And that just might be an impossible bridge to pass over.
Yeah, because the typical person who's buying a house, whatever money they can scrape together, that's their down payment.
Yeah.
And now what in effect you're saying is, oh, guess what? You've got to come up with another $50,000 on your down payment because the bank isn't going to fund it as part of the mortgage. Correct. So that's another reason the whole thing can collapse.
Well, let's explore the final leg of the destruction of that sale transaction is that you bought a house before you sold your house. And you had an expectation of what you would get as a sale price on that house. So you go ahead, buy the new house, put $100,000 down, $50,000, $25,000 a deposit. You're going to sell your house to get the proceeds you need to complete that transaction, to buy the new house. Well, you can't even sell your old house. Like there's no showings. There's no offer on offer night. There's no nothing. It's a literal disaster. Or you have to start discounting your house. And by the way, the more I discount my house, the less proceeds there will be. And now I don't have enough down payment to complete the transaction on the new, bigger house. Like, honestly, it's a rolling series of disasters.
And so we are not at the peak of the tsunami. We're not even close to it yet.
It's not a tsunami because, let's face it, some people are conservative and they sold the house first. Some people have a very large down payment, and when the appraisal fails, that doesn't have as much effect. If you're putting $40,000 down, the bank could conceivably increase 40% down, I should say. If you're putting 40% down, the bank will consider an 80% mortgage, so you actually have a little room when the appraisal fails. You can manage that problem. You can get it to work. So tsunami is the wrong word, but a rolling series of disasters for some consumers is a pretty accurate description of some home buyers right now.
So you're optimistic for my business a year from now, then, is what you're saying then, Ron?
I'm optimistic for your business because of the looming threat of recession. So, but no, right now we're going through the phase of, we went through this in 2017. We went through a version of it in 2008, as I'm very old. I've been doing this for a very long time, so I've seen a lot of things that other people have not seen. This is the initial stage of a housing price downturn, housing market downturn, activity falling off, prices going lower, values dropping. The initial phase is these accidents that occur because you're mid-transaction. The consumer's in mid-transaction, the house buyer, the house seller, they're in a transaction. And in the very worst possible time, there's a market upheaval during the course of the transactions. This isn't a huge number of people, but it is incredibly painful for everybody involved. I mean, it's a complete horror show. And that it will probably settle itself out by the mid to the end of the summer. Like, everybody will be much more cautious, much more careful. They're probably all sell their, we've actually even seen conditions in real estate transactions when they're saying, you can get out of this if you can't sell your home. You can get out of this if the appraisal fails. We've actually started to see those kind of conditions coming in. So escape clause conditions are starting to appear. Not many, just a few, but it was totally non-existent for the last 2 years. It just didn't exist. You couldn't have any condition. Your just condition was, I promised to buy, here's $100,000 deposit, and I waive every possible thing that I could waive. I mean, I just want to get this house. That's all changed. So we will see the market adapt. It will change. So these accidents, these people who are caught in the transition problem of the market deterioration, there will be very few of them by the time the end of the summer rolls around.
Yeah, and I get that. If I bought something at the beginning of February, I assumed it would keep going up, so I didn't worry about all this other stuff. If I'm buying something today, I'm a lot more cautious, and therefore I'm less likely to get myself into trouble.
Yeah, and all the people who are helping you with the transaction are a lot more cautious too, because realtors are really, really disinterested in if the transaction fails, they've not only got zero pay, but they've got to expend an incredible amount of hours in trying to fix it and deal with it. And the emails and the calls back and forth. I mean, we're going to quickly reach a point where a realtor is going to want the deal to be just a mortal lock before they're going to want to approach it. Same for the lawyers, same even for people like me, that we don't want to invest a ton of time in a transaction that we know could be fraught with jeopardy. And so that'll sift through the whole system. And again, by summer, it'll become a much more conservative, careful, and more accident-free environment by the end of the summer.
So if I come to you and I say, Ron, I'd like to buy a house. I'm not in any hurry. Like I'm fine now. Maybe I just moved here from another province. I need a place to live. Your advice to me would be what?
Just rent.
Just rent.
Just rent. Just rent for a year. Rent for 6 months. Rent for a year. Rent month to month. You need to pause and watch what's going to happen. I mean, as I said, the price of some properties is off 15%. Some properties are off 20% from this peak in February of 2022. And some properties are probably off 25%. So it's 10 weeks. So let's pause. If you don't absolutely positively have to buy and sell, like those really unfortunate people in situations of marriage breakdown, just wait. Now, there's a bunch of realtors, if they ever listen to this program, there's a bunch of real estate agents who think this is literally the worst thing that anyone could ever say. I mean, wait. What do you mean wait? You expect me to go with no transactions for 4 months? I mean, that's horrible. Some honest realtors might say wait, and there's a bunch of them. They're not, sometimes we make fun of realtors, but there's a lot of great professionals out there too, who do a great job. And same is true for mortgage brokers. But there's some who would say, don't talk about bad news. Don't ever give out any bad news. Don't ever just say anything that would impede a transaction. Don't do that. But if you have a shred of honesty and you've seen the changes we've seen in 10 weeks, you have to tell people that you should at least stop and wait and observe. Okay. I mean, 10 weeks.
Yeah. And if you're playing the long game, okay, so I'm not going to do any sales the next 2 or 3 months, but then in the next 6 months or in the next year, I'm going to do twice as many. So I'm going to get it all back and more, but my clients
some of them will be out of the business,
right.
Doug, and they will be your customers.
Yep.
Okay.
Yep.
But the reality for the consumer is this. If you talk to people who bought a home after 1990, now I know I'm going back 30 years and people are saying, well, why don't you talk about the Stone Age? The 30 years is the same as the Stone Age. But when you're old like me, it's not really the Stone Age. But I will tell you, people who bought 1990 through 1996, some of those people will tell you this was the greatest stroke of luck that ever happened. I bought at the absolute bottom and the value of my house increased astronomically. And it's enormously helped my wealth. And it really didn't matter the interest rates were higher in the 1990s because the strike price of my purchase was at the lowest ebb. And interest rates change. I mean, interest rates aren't permanent, but the price I bought for the house, the price I paid for the house is set. That's all I paid. I didn't pay, and there's no give the vendor back some extra money, if it's worth more in 5 years. I paid that strike price. That was a great deal in 1992 or 1994, and interest rates eventually went down again. So.
Well, and you speak about the Stone Age. I've pulled out a copy of my book, Straight Talk on Your Money, still available on Amazon. I bought a house in 1989. So
that's tough.
Yes. Trust me, I know. I tell about it on page 123 of my book here. And I thought the market had peaked around 1987, 1989, whatever, in 1988. So I figured, and prices had started to come down a little bit in 1989. So this was north of Toronto. It was a condo a townhouse condo, and in that complex, somebody had paid $275,000. I bought mine for $205,000. So I thought, hey, look at this. I've nailed this. I ended up selling that house 7 years later when I got married and moved out west here for $20,000 less than I paid for it. So I owned a house for 7 years and lost $20,000. Nobody.
It was possible, yes.
It was. Yeah. And guess what? If you bought a house on February 1st of 2022, it may very well be a year or 2 or 5 or 10 before you can sell the house again for what you paid for it. When do you think the break-even point will come? I mean, you don't know. Nobody knows. We're speculating.
Nobody knows. I mean, the good analogy, it's actually, talking about 1989, 1990 is useful because from 1990, if you'd have bought in, as you said, in 1989, 88, 89, when you start to factor in inflation, the house never got back to the correct, to the value you paid once inflation is factored in until 2014. 2014, it was, some people it was 14 years when you factor inflation in to get back to the same value as you purchased it for. So yeah, things can go wrong in real estate. I mean, they absolutely can. And I'm afraid for some people, things have gone wrong. There's no question about it.
Yeah. And so your advice is to pause. And I kind of like that advice. I deal with a lot of clients who've gone through some hard times for whatever reason. They end up filing a consumer proposal, bankruptcy, whatever. And a lot of them say to me, hey, look, at some point I want to be able to buy a house. And I say, no problem. Let's deal with your debt first. Number 2, you want to build up a down payment. Number 3, you want to have an income, obviously. But if I don't get that house today, I'm never going to get one. Well, that was certainly the case over the last few years, but that may not be the case over the next few years, because being out of the market now over the next number of months may not be as devastating as it was being out of the market during the boom time. So I kind of like your advice. Just pause and chill out. So I think that's an excellent way to end it. Are there any other, points you want to throw in here that we haven't talked about other than the rolling series of disasters that you've already addressed?
So really, I've got to continue to emphasize this point about the strike price that you pay for a house and the interest rates, because you do hear a bunch of chatter online, like you say, all wisdom is online. Mm-hmm. You do hear chatter online. Well, my God, if the rates go so high, it won't matter that the price of the home has fallen. I mean, my payments will be so big, because as you and I both know, Doug, nobody cares about the debt anymore. They only care about the payments.
Yep.
That is a universal truth of the financialization of our society. People 40 years ago talked about the amount of debt all the time. Even 30 years ago, you heard a lot about, well, the mortgage is big. It's $128,000. Boy, that's big. So in the last 30 years, that whole concept has evaporated just to the payment. What am I paying? But I think we're going to really start to see more people wondering about, what is the payment on it? When this $800,000 mortgage renews, if it's renewing in 2 years and the rates are in the fives, what will I have to pay? I mean, that's going to be, the amount of the debt is going to start to become a real thing in the near future. But I really want to point this out to people. Interest rates change. The price you paid for the house is forever. So that should be a key driver in your thinking. And finally, for all those people who are going to be experiencing renewals in the next year or two, please start thinking about it now. I mean, seriously, you might not have a renewal for a year, but start thinking about it now. You can pull out that handy dandy mortgage calculator. There's more than just on my website. They're everywhere. And okay, if I'm paying 2.89 or 2.49 now, if the rate's 4.14, what would my payments be? Oh, and by the way, you started with a 30-year amortization, so now it's 25 years. So you got to plug that number in as well. Or you started at 25 and now it's 20. You got to plug that number in as well and start to think about what your payment's going to be a year from now. You might say to yourself, well, maybe interest rates are going down. Well, they might, but actually they won't. They're not going to go down. They're not going to go way down at any point in the next 12 months. They're not going to be a sudden reversion and all of a sudden we're going to have this ultra low rates that we had. No, not happening. Rates are probably going to look a lot like they are right now. Variable will be higher, has to be, because prime is going to go up. It's going to go up at least another 1%, maybe 1.25%. Worst case scenario, 2% more for prime. That's the worst case, I think, this year. But you've got to start thinking about, if you've got a renewal next year, you should start thinking about it now. Start looking at the financial effect on your budgeting, on what's going to happen in the future, and maybe start thinking about methods to try to deal with it. Reach out to a mortgage professional, reach out to your bank. Start to think hard about how you're going to deal with this renewal in the next 12 months.
Yeah, because if you've got a fixed mortgage, well, the interest rates haven't affected you yet because I'm locked in till next year. But it will be a big shock. And yeah, I mean, rates doubling, that doesn't mean your mortgage payment doubles because that's not how amortization works, but it sure can go up a lot. So I agree. You've always got to be looking ahead and saying, what do I need to do to mitigate the damage, to be prepared for it? Because if you're prepared for it, you got a fighting chance. So, well, on that happy note, Ron, I really appreciate you being here. But, you've been honest. So again, I'm not selling anything here. So I think it's much better that you tell people what you think and then let them do their own research. So they can find you on Twitter, Ron Mortgage Guy. I'll put a link in the show notes. And then your website, butlermortgage.ca. I'll put a link to the mortgage calculator, which is what I've been quoting from here. Lots of other information there as well. And I guess we shall see how the next few months unfold.
I look at it this way. We started with a mortgage podcast and a funeral broke out.
There you go. Yeah.
That's what we're looking at.
Well, but this is what's happening. So we might as well talk about what's happening. I mean,
Absolutely.
like you said, the mortgage brokers made tons of money last year, as did real estate agents and a lot of other people. Okay, well, maybe we're in for some lean times, but it is what it is. Ron, thanks very much for being here today.
Thanks, Doug. Always good to see you.
Thank you very much. That was Ron Butler, Ron the Mortgage Guy. Links to everything we talked about will be in the show notes on YouTube. Please subscribe, hit the like button. New podcast comes out every week. And if you're listening on your audio platform, Apple Podcast, Spotify, whatever, hit the subscribe button so you are notified of each new show. That's it for me. Thank you very much for listening and watching. Until next week, I'm Doug Hoyes. That was Debt Free in 30.